Patrick, we're finally getting this news of this travel bubble between Singapore and Hong Kong. This is one thing that I guess investors have been looking for when we start to see global travel open up once again, and how that's going to feed through into the energy market too. Let's get to our question of the day, which is when will crude get back to these March highs? What's your view, Patrick?
Good morning there. Look, we're not specialized in energy analysis, but I would say this is all part of that same theme that we're seeing in emerging markets, or Asia in particular, just having much better control of the virus situation, just having it, I wouldn't say vanquished, but keeping it under control, being able to reopen more quickly as we're seeing in China. And being able to establish these sorts of things. And I think that all adds to the bullish case for emerging market equities in particular, which we've been talking about for quite a while, and how we're positioned.
Let's also talk about what we're seeing in terms of this rotation that we have been seeing on the vaccine news as well. We have a chart which has been showing what we're seeing in terms of this growth value rotation. Do you think this continues? This is kind of the news that we've all been waiting for, but there's still a lot of questions, I guess, about when we see this vaccine and how, of course, it's going to be handed out globally.
I think you're exactly right there. This is the news we've all been waiting for. And I think it's been for months, it's been quite predictable that on the day when we would see the first big virus announcement, that we were going to see this sort of rotation. And you can talk about it from growth into value, but I think, and that's part of it. But I think even more importantly, it's really rotation into the stocks and names that have suffered from the lockdown. So into the reopening winners from here. And, it's clear that we're getting a lot of rotation in the first place. But as you said, the actual rollout of vaccines, and not just this one, is going to take months. Sure, markets are going to price that in well ahead of the actual things happening in the real economy and happening on the ground. But, I think we'll get a first burst of rotation. And after that, I think it will slow down markedly. It won't go away. But don't expect the pace of rotation to keep going like this.
Patrick, when we talk about rotation, we're also talking here about, and I've got a chart to show this, I know you can't see it, but what it does show is how we've seen developed markets essentially being outperforming, but of late, what we see are emerging markets that are coming back, EM stocks starting to outperform developed ones. And that's actually after they mostly lagged since that March sell-off that we see. What's behind it? And secondly, does this continue? So,
first of all, you have to bear in mind also pre-March, emerging markets didn't sell off as much as developed markets. Again, for the same reason that they had their sort of virus scare a little bit earlier, not as bad, and came out of it with different timing. We think from here, emerging markets are probably the clearest regional winner that you can point to. I think again with an emphasis on Asia. And if you just think about the developments that we're having on the political front, it does look like in the tensions between the US and China will probably get better from here. With loose monetary policy from here, I also think the dollar is probably going to weaken. There's also political angle from that. And with the global economy recovering into next year with emerging markets, you are also getting that gearing into a reviving trade, export growth cycle. So actually, I think the stars are sort of lining up for emerging markets. And that's really our clearest conviction when you're talking about regional views.
Now, Patrick, it's interesting. You have a call here on the dollar over a 10 to 15-year time horizon of depreciation. That's not going to be good for U.S. assets, is it?
Well, it really depends. It really depends where you sit, really, and how you look at the currency. Actually, if you're a U.S. exporter, you probably do like a weaker dollar at the margin. So. I think from a corporate standpoint that's arguable. If you look over 10 to 15-year horizon, I think the clear fact is just the US dollar has been overvalued for many years now. It's given back a good chunk of that, but there's still some remaining. And, it's not clear that the US will continue to outgrow the rest of the world at the same pace it has. And we've really looked, at a decade plus of American exceptionalism where the US dollar has done better, but in particular, US equities have outperformed the rest of the world really since the global financial crisis. And as you say, we've just published our 10 to 15-year strategic annual outlook, the long-term capital market assumptions. And one of the themes that we're picking up is it does look like the US will struggle to keep outperforming the rest of the world like it has done over the last 10 years, looking at the next 10 years. We think that that's going to be, there's a lot of headwinds lining up there.
Well, talking of headwinds, what are the biggest risks short-term currently? And if I was to pick out three, COVID in Europe as it's exponentially growing there, as well as the United States, those are factors, walls of worry, if you will. Then on top of that, we could have gridlock in Congress. And then, of course, this drawn-out election process, which is being contested by the incumbent.
I think you're pointing out a lot of the big ones right there. I think despite the fact that we've had good news on the vaccine right here, right now, we're still looking at an acceleration in cases. Europe, we've talked about for a while, but the US may be catching up right now. The US political situation is still somewhat unclear. And if this draws on, that could hit risk appetite. I guess one that you didn't mention there, Rish, is bond yields. I guess, we have seen a big move in US Treasuries in particular. Equity markets gave up a lot of that, initial euphoria, at least in index level terms, but bond yields haven't. So we don't think that will happen. But if we do see an unruly move, a fast move by bond yields higher, say to 150 on the 10-year point, that could be a risk. It's not our view, given how much central bank policy is out there. But, if it did happen, I don't think risk assets would like that.